Welcome. So you're looking to get a handle on momentum trading, maybe understand it quickly, but thoroughly.
Exactly. We're diving into Trading on Momentum by Ken Wolff and Chris Schumacher from back in 2002.
Right. And the goal is to pull out the key insights, the core stuff, without getting bogged down in every single detail.
Precisely. We want to understand their approach, what makes it unique, and, the kind of mindset you'd need for it.
And this book, it wasn't written in a vacuum, was it? They acknowledge people like Ela Acte, Beth Brown, Victor Young, Steve Damaris.
Yeah, contributors and partners. But what's really interesting is their shout out to the online communities.
Yeah.
mtrader.com, realitytrader.com.
Ah, those early forums. So the actual online traders helped shape their thinking.
Seems like it played a big role, which makes sense given the time. Late 90s online trading was just exploding.
Oh, definitely. Suddenly everyone was jumping in, right? Chasing those high-flying tech stocks, Qualcomm, Yahoo.
iOmega, Cisco.
Yeah.
Yeah, those names were everywhere. It felt like a whole new game.
And honestly, there was this sense, wasn't there, that maybe making money in the market was suddenly easy.
There was definitely that perception, yeah. Maybe some aha moments thinking this was the path to quick wealth.
So our mission today is really to understand the fundamentals of momentum trading as they saw it back then.
Exactly. What are the core mechanics? What makes it different? And crucially, what kind of mental game do you need to play?
Okay, let's start there. What is momentum trading, according to Wolff and Schumacher, at its most basic?
The core idea, they say, is focusing on what's happening right now, what the tape is currently showing.
So less predicting the future, more reacting to the present.
Pretty much. Reading the immediate price action, not trying to forecast based on fundamentals or, long-term analysis. The aim is to cut out the guesswork.
That sounds appealing, actually, if you're tired of all the predictions.
Right. And the book's premise is that this approach works because of predictable cycles. Cycles caused by, well, human emotion.
Fear and greed, the classic ones.
Exactly. They argue that inexperienced traders tend to overreact to news, to hype, to market swings driven by fear and greed.
And those overreactions create patterns, momentum patterns that can be traded. That could be an aha moment right there.
That's their core argument, that these mass psychological responses create tradable momentum.
But tapping into that emotional volatility, that sounds risky. There has to be a downside.
Oh, absolutely. They're very upfront about the high failure rate. A lot of people jump in and lose.
Why? What's the main reason people fail at this, according to them?
Lack of education, mostly. Jumping into this complex, fast-moving game without really understanding it.
So the book aims to bridge that gap, give individuals the kind of insights professionals might have.
That's the stated goal. To level the playing field a bit by sharing advanced methods and the psychology behind it all. For you, the reader.
Okay, how do they structure this knowledge? How does the book lay it all out?
It's basically in parts. Part 1, the first few chapters, covers the basics. The market itself, sure, but also the tools.
Tools like
Market makers, for one, understanding their role, and importantly, online forums and how orders actually get routed.
order routing. Yeah, that sounds like jargon city for a beginner.
It can be, but they stress it's vital. You need to know how your buy or sell actually happens. They also talk a lot about online chat rooms.
The influence they had back then.
Huge influence, apparently. Understanding how those chat rooms could move stocks was key, even if you weren't participating. It's like knowing the currents.
Makes sense. What else in that first part?
They touch on more advanced tools for active traders, too, and they frame it all in the context of the market then.
How so?
Well, they mention things like Intel and Microsoft joining the Dow Jones Industrial Average in late '99.
Right, replacing older industrial companies. A big shift.
Exactly, signaling the rise of tech, the dot-com era really taking hold.
So they tie the trading concepts to the actual market environment.
Yes, and they introduced the different indices, Russell 2000 for small caps, Nasdaq, the broad Wilshire 5000, AMX, S&P 500.
The point being,
You need to know which market people are talking about. They don't all move together. Understanding the segment is important.
okay, so theory, tools, market context. Now, what about practical stuff, like day-to-day needs?
They get into that too. A big one was internet speed. They specifically say cable, not a 56K modem.
A 56K modem. Takes you back. Why was speed so critical?
Lagging quotes. Especially during high volume, like the market open. If your quotes are delayed, you're trading on old news.
A massive disadvantage in momentum trading, I'd imagine.
Huge. Milliseconds matter.
Yeah.
So a fast connection was about staying competitive, making sure you weren't technically behind.
Okay, so you've got the setup, you're starting to grasp the market. How do you actually learn to trade momentum? What paths do they suggest?
They lay out three main ways. First, mentorship, learning directly from a successful trader.
The apprenticeship model, basically.
Yeah, they say it's the best way, but also the hardest to find. Someone genuinely good who's willing to teach.
Makes sense. What's the second way?
Self-education, reading trading books like theirs, absorbing the knowledge.
The upside being accessibility, the downside.
It gives you the theory, the basic knowledge, but it lacks that real-time live market experience. You're not seeing it applied.
Okay, and the third.
Online mentorship, joining those forums they mentioned, mtrader.com or realitytrader.com, learning within that online community.
So a spectrum. One-on-one, self-study, or community learning. How do you choose?
Well, they weigh the pros and cons. Like on-site training face-to-face with pros gives you that personalized intensive crash course, level 1, level 2, time of sales.
But expensive, right? They mentioned figures.
Very. $1,000 to $5,000 a week back then. A significant investment. Online forums are more accessible, obviously.
But with online resources, trust becomes a big issue.
Huge. They really stress finding guidance that focuses on fundamentals, money management, stop losses, not just hot stock picks.
And a place where you feel comfortable asking questions.
Exactly. A supportive atmosphere. Not feeling intimidated if you need to ask basic stuff. It avoids that feeling of being overwhelmed.
So differentiate between forums just throwing out picks versus those actually teaching you to build your own strategy.
Precisely. They're very clear. Blindly following someone else's trades, not a winning long-term strategy.
A good forum should help you prepare, maybe suggest stocks to watch, but help you form your own plan.
Yes. But they also warn about the dark side of those forums.
Yes. The dangers. What should people watch out for?
Well, one thing is channel momentum. A chat room leader pumps a stock after they've already bought it.
So their followers pile in, push the price up.
And the leader sells into that buying pressure for a profit. Often happens with low-volume stocks. Easier to manipulate.
Doesn't sound like mentorship. Sounds like using your followers.
It can be. Then there are news alerts. Similar idea. A leader hypes a stock based on some news.
Having already bought it low, presumably?
Often, yes. They encourage members to buy, maybe even while they're quietly selling their own shares, or even shorting at the peak they helped create.
Wow. And sometimes multiple forums pushing the same stock.
Yeah, they mentioned that too. Creates this illusion of widespread momentum, but it can be totally artificial.
So the big takeaway is be skeptical. Don't just trust chat room leaders.
Absolutely. They point out these leaders rarely post their losses, and if trade goes bad, they often blame the members for not doing their own research.
Convenient?
Very. The book says learning to tell real news from hype comes from personal experience, watching how stocks actually react.
Okay, let's shift gears. Mindset. Someone's starting out. What's the mental game?
First thing, ditch the get-rich-quick fantasy. They are blunt about this.
Right.
Trading is about building consistently over time, not overnight millions.
A reality check right off the bat.
Essential.
Yeah.
Expecting easy money leads to bad decisions. You also need enough starting capital.
And be aware of the failure rate. They mentioned a high percentage.
Yeah, 70–80% of new traders consistently lose and quit. It's sobering.
What separates the ones who make it?
Education, like we discussed, and discipline, especially discipline around managing losses.
The stop loss? That seems critical in their view.
Absolutely critical. Stick to your stop losses. Prevent small losses from snowballing into account killers.
And view losses differently, not as failure.
Kind of. A small controlled loss is actually a success because it stopped a potentially much bigger one. It's a tough mental shift.
Yeah, reframing a loss as risk management.
And avoiding emotional trading. Don't treat every trade like it's life or death or a reflection of your self-worth.
Detachment is key. Limit losses, maximize gains. Simple goal, hard execution.
Exactly. Successful traders, they argue, make profits consistently through that disciplined, unemotional approach, not overnight windfalls.
So before risking any real money, what's the absolute must-do step?
Paper trading. They hammer this home. No matter your background, paper trade first when learning or testing any new method.
Why is it so non-negotiable for them?
3 reasons. Protects your capital, obviously. Builds confidence that you actually understand the method. And proves to yourself that it can work, at least in simulation.
Like a flight simulator before flying a real plane.
Perfect analogy. And they talk about why moving from paper to live trading is so hard.
The fear factor kicks in.
Exactly. Fear of losing real money. Suddenly you hesitate. You don't follow the plan that worked on paper. Plus uncertainty about execution.
Right. Will my order actually get filled where I want it, especially if things move fast?
That's a big worry. So their advice is start live trading with small share sizes, really small.
To learn the ropes of execution without the terror of big losses.
Precisely. Get comfortable with how orders work in the real market. The goal is to develop an indifference to each trade. See it as just one data point.
Okay, let's dig into those tools again, specifically order execution. How did they see the landscape back then?
They talked about traditional brokers versus the web-based ones like E-Trade or Schwab that were becoming popular.
And the web-based ones were simpler for beginners?
Generally, yes, because the broker handled the routing. You just put in the ticker and shares. Less control, but simpler.
And the alternative, more direct control.
Yes. Electronic direct access trading firms, or EDATs. These gave you more options, more control, but required you to understand the different execution routes.
Like SOES, they mentioned that one.
Right, the small order execution system. Automatic execution for small orders, but with limits. Couldn't use it for ECNs, for example.
ECNs being electronic communication networks, like alternative exchanges.
Exactly. And SOES had this weird 17-second delay for market makers after they filled their quote.
17 seconds? That's an eternity in a fast market.
It really is. Then there was SelectNet. It had two main types.
Okay.
Broadcast orders, SNET broad, visible to all market makers but no guarantee of a fill. Easily ignored in fast stocks.
Like shouting into the void and hoping someone listens.
Pretty much. The other type was preference orders, SysNet pre-F. This one obligated the chosen market maker to respond, accept, decline, partial fill.
Ah, so more certainty. And could you use that for ECNs?
Yes, that was key. You could preference an ECN directly for an auto execution. They give an example using Intraday INCA. Speed was the advantage here.
So understanding these routes was a real edge.
Huge. There's an anecdote in the book. One author missed a trade using SOES while someone else got filled fast using SelectNet preference on the same news.
But SelectNet had downsides too.
Yeah, in really crazy markets, there was a 10-second hold before you could cancel, and market makers had up to 30 seconds to respond. That delay could hurt.
Trade-offs everywhere. So how did you trade directly with ECNs like Island ISLD?
Since they weren't on SOES, you needed SelectNet preference routed to ISLD or a direct ECN order if your platform allowed it. They mentioned anticipating changes with SuperSOES rules coming later, though.
Mastering execution sounds like a skill in itself.
Definitely. They also mentioned RCA routing, if you had access, described as a smart route.
How did that work?
It used algorithms to find the best price. Looked in its own book first, then used SelectNet to hit ECNs, then finally routed to market makers if needed. Designed for efficiency.
Okay, beyond execution routes, what other essential screens or tools did they emphasize?
Level 1 and Level 2 quotes were non-negotiable, plus time of sales, charting tools, and a reliable news feed.
Level 1 is the basic quote we see everywhere, right? Bid, ask, last price, volume.
Yep. Ticker, change, high-low, open, close, last size, all the basics. Each piece tells you something.
And Level 2 adds.
Depth. It shows the individual bids and asks from different market makers and ECNs. How many shares are offered or wanted at each specific price level?
Gives you a sense of supply and demand right there on the screen.
Exactly. Though they do warn about a potential Nasdaq bottleneck back then, causing delays in Level 2, especially right at the open. So you had to be aware the picture might not be perfectly real-time.
Got it. Always be aware of the potential limitations of your tools.
Crucial point.
Now, they talk about this new market momentum driven by the internet. What changed?
The big change was individual traders getting fast access to information earnings, SEC filings, analyst reports, news. Power shifted away from big brokerage houses.
Information democratization, essentially.
Sort of, yeah. And because individuals could get info and react faster, it amplified the impact of fear and greed.
Created a faster, maybe more emotionally driven momentum.
That's the argument. A new kind of momentum driven by this mass psychology, reacting quickly online. Like an early version of social media affecting markets.
So individual traders became a bigger force. Could they figure out what the big institutions were doing?
The book basically says don't bother trying. Institutions have access to info. Individuals don't. Trying to guess their moves is mostly a waste of time.
Focus on what you can see and analyze.
Right. But they do say online traders could create momentum, especially in stocks with low floats, if there was fresh news or hype.
They mentioned some tickers. MZON, KTEL.
Yeah, examples from that era. The pattern was often a quick spike up, then a sharp fall back down.
The classic pump and dump risk.
Can be, yeah. This leads them to predictable momentum, not predicting the future, but studying how other active traders play the game.
Like scouting the opponent in sports, watching game film.
Exactly. Understanding common tactics and reactions. And for this, liquidity and volume are key.
Why?
Can't get in or out easily if nobody's trading it. Low volume, illiquid stocks are dangerous. You need moderate to fast volume, enough people playing the game.
And enough price movement.
Yep, a decent intraday range, so there's actually profit potential. You need entry and exit plans relative to that expected range.
And momentum isn't constant, right? It ebbs and flows.
Correct. It speeds up, slows down, offers different opportunities. Even slow momentum stocks can be profitable just over a different time frame.
What about the market makers in this? Are they the enemy trying to trick traders?
The book suggests that's an oversimplification. Their main job is providing liquidity, filling client orders, managing their own inventory. They're not primarily focused on taking out individual traders.
Their actions are driven by order flow and risk management.
Largely, yes. They also discuss breakout trades moving above a prior high.
Those often fizzle out.
Often small gains, followed by sharp pullbacks, yeah. Need quick entry and exit. Scalpers trading big volume can still profit from tiny moves, though.
Right, making fractions of a point on huge share counts.
Exactly. They contrast this with things like IPOs, which they actually call dangerous for day traders.
Why dangerous?
Extreme volatility, rapid moves, and poor execution slippage. Getting filled way worse than you expected.
Sounds stressful. And news alerts, we touched on that. Scalpers try to get in fast.
Yeah, jump in on the news, hope latecomers push it higher, then sell into that strength for a quick small profit.
But don't chase it after the move. High percentage versus low percentage trades.
Exactly. Getting in before the reaction is high percentage, chasing it is low. Much riskier.
And beware the chat room hype pushing people to buy at the top.
Right, while the hypers likely got in much lower. But pullbacks after a news spike can offer scalp opportunities at support levels.
So potential chances even after the initial frenzy.
Potentially. But again, be careful with chat room chatter after news. People who missed out might downplay it. Shorts might try to cause panic.
Trust the price action and your own analysis more than the commentary.
That's the message. High percentage trading comes from identifying and exploiting repeating patterns, having a game plan. Otherwise, it's overwhelming.
Do they give examples of specific patterns they looked for?
They do. First day gainers, buying the first uptick or first dip right after the open.
Okay.
Weak news reaction, shorting the first rally when the market overreacts to news that isn't that great, then covering when it fades.
Playing the overreaction.
And the dumper pattern, looking for bounces the next day after a stock dropped hard on mediocre bad news, like a slight earnings miss. But avoid stocks with catastrophic news.
So capitalizing on overreactions and potential reversals makes sense.
Yeah, and they link these to historical examples, like FDA news or .com deals, moving stocks like BAM or MZON.
They also mention pre-market gap analysis, looking at stocks opening much higher or lower.
Yes, but with caveats. Not all good news creates a gap. And be wary of potentially fake market maker quotes before the official pre-market trading starts.
Don't trust those early indications blindly.
Right. Track gapping stocks on level 1, then level 2. Look for a real gap, confirming news, good volume.
And watch closely at the open.
Very closely. How big is the gap? Does it dip first? Bounce? How many bottoms form? Does it just climb? How strong is the story? All clues.
This sounds like where the tracking diary becomes essential.
Absolutely. Its whole purpose is to build a database of how these patterns typically behave. That builds your expectations, informs your game plan for the day.
So you can anticipate, say, how a second-day gainer might act based on what you've tracked before.
Exactly. Maybe you expect a dip after the gap based on past data, or maybe you expect a strong climb if it didn't dip much on day 1.
And the diary can also warn you when things aren't acting normally.
Yes. If patterns aren't playing out as expected, maybe due to weird market conditions, the diary might signal stay away. It's about probabilities, not certainties.
It shows what tends to happen, a statistical edge.
Precisely.
What about that 20% rule for shorting big gainers? Did that hold up?
Historically, maybe. A 20% intraday gain often signaled the top. But in the late 90s, boom, forget it. Stocks ran 40%, 50%, 200% sometimes.
So shorting those was incredibly risky.
Extremely. They call them runners, fast movers, small pullbacks, just keep making new highs. They strongly warn against shorting runners in those speculative markets.
So adapt the rules to the environment. Trade gainers day one on upticks, pullbacks. Day two, look for weakening, maybe shorts or pullback buys, always considering the market.
That's the gist. Always be aware of the bigger picture.
Which brings us to market dynamics. These larger forces, what are they talking about here?
Basically, the broader market influences that impact individual stocks. Things newbies might ignore. They suggest mastering the core stock patterns first, though.
Don't bite off too much at once.
Right. But unexpected market events, good or bad, create momentum across the board. Like a stock misses earnings, gaps down.
That's expected.
But then maybe value investors step in because it looks cheap. That's a broader dynamic influencing the expected pattern.
So understanding the interplay between the stock-specific event and the overall market reaction.
Yes. And that volatility in the new market created more opportunity for disciplined traders who understood these dynamics.
They categorize market players, investors, institutions, active traders.
Yeah, and how their combined actions drive big moves. Think the internet boom, then money rotating into other sectors later. It's the flow of capital.
Understanding who's driving the bus at any given time.
Kind of. They define the NW market, pre-market, the open intraday swings after hours. Emphasizing pre-market prep is key to understanding the day's potential.
Looking for cycles or time-based patterns, too.
Yeah, trying to spot potential shifts in sentiment based on recurring time-of-day activity.
And some general observations about dynamics, like first day versus second day gainers.
Right. Day one gainers often gap up more. Day two gainers might have more shorts involved. Be careful shorting big gap downs because of potential value buying. Use 20-day charts for context on buying-selling pressure.
Okay, and the runner pattern in dynamics.
Big initial climb, say $5, then a smaller pullback, maybe 50, 75 cents, before continuing. Again, super risky to short. Identifying the actual top takes a lot of experience.
They mentioned a mid-range rule, too.
Yeah, for high flyers. If it closes below the middle of its daily range, that's a sign of weakening. Shorts might hold, maybe cover on the first uptick if it gaps up the next day, using the close versus the range as a strength indicator.
So pulling all these dynamics together, they break it down further.
Into 5 components for gainers: sector strength, historical market strength, current market, macro momentum, day trader strength, and the stock's own micro momentum.
Okay, how do you gauge all that?
Watching other high-volume stocks in the sector, looking at small-cap performance for day trader activity, Nasdaq's 3-day trend for macro momentum, things like that.
It's a multi-layered assessment of strength.
Exactly. And news type matters. Biotech FDA news is super reactive. Earnings surprises, too.
And you combine these, like good news in a weak sector means.
Be more cautious. Maybe wait for a confirmed bottom instead of buying the open aggressively. Adjust your plan based on the combined signals.
Trading differently in a strong overall market versus a weak one.
Right. In a really bad market, maybe your main strategy becomes shorting stocks that gap up slightly. And if all the indicators are conflicting,
Stay out.
that might be the best move. Wait for clarity. Understanding all this takes time and diligent tracking.
So combining market dynamics with the core stock patterns and indicator stocks gives the full picture.
That's the idea, a comprehensive view of the forces at play.
And the tracking diary is key to it all.
Absolutely paramount. To build expectations, avoid trading blind, they detail how to build it.
Like categorizing stocks by news type, setting volume price criteria.
Listing them, recording futures, pre-market index closes, then tracking stock prices at half-hour intervals.
That is detailed. Noting the action, especially the first couple of hours.
Yep, 9:30 a.m. to noon Eastern, calculating potential profit on tops and bottoms. Moving day one stocks to the day two list for the next day, then analyzing all that data.
And this data tells you how to trade. Based on futures, index moves, gainer behavior.
It informs your decisions. Adjust profit targets. Lean towards longs or shorts based on the overall picture your tracking reveals. Market dynamics will ultimately shift the patterns you see.
The diary helps you adapt. What about that, quote, delay issue they mentioned? The Nasdaq bottleneck.
Yeah, the funnel effect. Nothing an individual could fix. But they offered a workaround.
How could you tell if quotes were delayed?
Try sending a select net preference or ECN order. If it gets rejected instantly, it means the market isn't actually where your screen says it is. The quotes are stale.
Ah, practical test. Clever.
Yeah, using the system's reaction to diagnose the data feed.
Okay, let's talk time of day. Do specific patterns emerge intraday?
They discuss typical flows like a stock runs from 40 to 45 early on, then it pulls back. Maybe the mid-range, 43, 43.50. If the overall market is strong, that pullback might be a long entry point.
With a target below the previous high.
Right. And you have plans if the bounce fails or if it breaks below that mid-range. The key is waiting for a clear bottom based on price action, not trying to perfectly knife catch the low.
Patience and confirmation. They mention upticks and downticks.
Just small price moves relative to the last bid ask. Important signals for some methods.
And this whole number in fractional theory sounds intriguing.
It's about psychology. Gauging predictability by how the masses react to round numbers like $40, $50. Trading the traders.
Example.
Stock pulls back from 42. You might look for buying to come in just above 40, maybe at 40 and an eighth or a quarter.
And fractional theory is anticipating that.
Yeah, maybe selling just before a big whole number resistance. If everyone's targeting $41, maybe sell at 40 and 3/4, 40.75 to lock in profit. Take the sure thing.
Clever. What about trading outside regular hours? Pre-market, after hours?
They advise caution. Lower liquidity, less reliable quotes compared to the main 9.30 to 4.0 Ether in session. More risk.
Okay. And tape reading, what does that involve?
Watching the flow of trades in real time. Understanding accumulation, steady buying, price rising on volume versus distribution. The opposite.
To anticipate moves before news even hits.
Potentially, yes. Reading the underlying pressure. They reiterate institutions drive major trends, not individuals, despite online influence on smaller stocks.
Like the Nasdaq boom and bust example, institutions drove the rise, then took profits, then bought the dip.
Exactly. Tape reading helps see those flows. Micro-level tape reading looks for steady buying, absorbing selling, or vice versa.
And the price spike panic selling idea.
Price and volume rise uptrend, but if volume slows near the peak, might be the top of that swing. Time to exit longs or consider shorts.
And the reverse for bottoms. Selling volume dries up after a fast drop.
Could signal a bottom, potential reversal point.
What's the market maker effect?
More visible in slower stocks. Watching for 1 consistently absorbing selling at the bid, support, or absorbing buying at the ask, resistance.
How do you spot that?
Seeing the same sitting there with size, maybe large block trades happening around them.
And what does it imply?
Example, shows big size on the ask, blocks trade below the bid, then the lifts their offer. Might mean a large seller is done. Price could go up. It facilitates the large order.
And the opposite for providing support. On the bid, blocks traded ask, drops off bid.
Could signal support is gone, maybe more downside. It's about understanding why the might be acting that way. Take reading is more than just counting buys versus sells.
Got it. Deeper than surface level.
Yeah.
The book then gets into rules of a trader and personal accountability. Big psychological shift needed from investing.
Huge shift. Got to separate the investor mindset from the short-term trader mindset. Money management, stop loss is critical for traders.
And those investing sayings, only a loss if you sell, stocks always come back. Dangerous for traders.
Very dangerous, they say. A primary cause of failure. Holding losers might work occasionally, but it wipes out profits from winners.
Whereas small stop losses give feedback.
Exactly. They tell you if your entries, exits, or the whole plan is working. One big loss tells you nothing useful.
What's golden rule #1, clear your spread?
Means when you buy at the ask, you want to see immediate buying push the bid up to or past your entry. That's your first sign the trade might work.
Focus on the here and now price action, not predictions.
Right. And sell immediately if that initial buying pressure reverses. Don't let ego, I'm right, the market's wrong, make you hold losers. Take accountability.
They also address the I'm always wrong mentality.
Yeah, that counterintuitive trader thing. They say you must trust your own system if you're trading actively. If you can't, maybe passive investing is better.
Base your exits on when your original reason for the trade changes, not hindsight.
Exactly. And golden rule #9, know thy source. Don't blindly follow gurus or tips. Be skeptical, test things yourself, use what works for you.
Ego is the enemy. Leads to blaming others, not learning.
Destructive force. The market doesn't care about your ego. It'll humble you eventually. Uncertainty is part of the game, causes stress.
What about intuitive trading?
They describe it as decisions based on deep experience and understanding, not clouded by external noise. Requires taking responsibility for your trades to learn.
Plan your trades, manage your capital, know you're up against pros.
Yes. Track your system's performance consistently. Know when it works best, when it doesn't.
And if you're out of sync with the market,
Step back. Reevaluate. Don't get more aggressive trying to force it or recoup losses. Passivity can be a strategy. Find your zone.
knowing when not to trade is crucial.
Very. They also suggest tracking indicator stocks like IBM, Intel back then that mirror the market to anticipate trends. Same for sectors like financials or biotech.
Sector momentum influenced by analysts, tech, demand can lead the market.
Can do, yeah. Watch for sector rotation. Pay attention to key stocks mentioned by big money managers.
And the day's action reflects the trend. Dips get bought in an uptrend.
Usually, wait out uncertainty. They talk macro momentum. Again, watch the strongest stocks, over 1M shares. Second-day gainers. Gauge buying-selling pressure.
Compare a strong stock's open dip and climb to gauge market strength. Ignore buyout stocks.
Right. Assess the daily mood, where strong stocks close within their range. Above mid-range positive, below negative, at Gellish neutral.
Be more aggressive on pullbacks in an uptrend, expecting reversals. Exit stocks weak relative to the market.
Yes. Note Dow versus Nasdaq divergence during rotations. Sheep follow leaders. Unexpected earnings from majors can ripple through.
And apply common sense, like analyzing a business.
Yeah, evaluate earnings, potential. Sector leaders are often institutional favorites.
Okay, wrapping up, they touch on momentum investing. How's that different?
It's about seeing how the small moves build into larger trends, like a nurse seeing subtle health changes. Momentum traders watch individual stocks closely.
The book's goal was to help struggling traders provide a foundation.
Yes, and the epilogue stresses this is just a starting point. Real trading experience is essential. Theory isn't enough.
Start slow, focus on one concept, paper trade until consistently profitable.
That's the strong recommendation. Education is ongoing. Find mentors, trading groups. They give their emails. Mention the chat rooms for questions, sharing ideas.
And the final advice.
Good luck, and keep those stops. Plus, there's a glossary, resource list, and index in the book.
A comprehensive package for its time, focused on that specific momentum approach.
Definitely. Captures that early online trading era, but the core ideas, price action, psychology, discipline, still resonate today, even if the market's evolved.
Well, as the learner, you should now have a much clearer picture of momentum trading according to Wolff and Schumacher's 2002 perspective. Hopefully these insights are useful, whether for professional context, general knowledge, or just curiosity about how markets work.
And maybe some of those perspectives, those aha moments about market psychology and the need for discipline, offer a springboard for your own thinking about trading or even decision-making in general.
That leads to a final thought. Given how much this approach emphasizes discipline and emotional control under pressure, what parts of your own decision-making, maybe even completely outside of finance, could benefit from applying those principles? Something to ponder.